Hey ladies and gentlemen, my name's Timber Robin and back with another episode of Interview Crew. So in this episode we sit down and have a conversation with Sean Ashton, a global investment manager who's put aside some time for us to pick his brain about investments and all things money. Once again, I apologize for the sound quality as it is recorded directly over Zoom. I will start with the session now. Cool. So when I refer to you as like your job title, what is it? An economist or?
So no, I'm not an economist. I actually, by training, I did an undergraduate degree in economics, but landed up in financial services initially as what's known in industry parlance as a sell-side research analyst, and that basically, in layman's terms, means that I spent a number of years of my early career analyzing companies, coming up with valuation models on companies, determining or trying to forecast where their earnings and prospects are going, and then presenting those views to the big pension fund managers that we have in South Africa, like your Old Mutuals, your Allan Greys, your Investec Asset Managements, the guys who ultimately made the investment decisions. So that was the first part of my career, which I spent at Nedcor Securities and later on at Deutsche Bank. But I've also moved across the floor, so to speak, to fund management myself over the years. Initially at Investec Wealth and Investment, subsequently a business called Anchor Capital, where I was the Chief Investment Officer for about 5 years.
Sure.
And that was up until, let's say, June 2018. I then left them and have started working with a previous client, ultra-high net worth individual, who has seeded a new global fund, which I'm managing on a company's platform called PIM Capital. It's a Mauritian-based fund, but it's dollar-denominated, and so it's global investments across largely equities, but also other asset classes too. So I've got the flexibility of looking at many different things. So I'm now finally in the seat of, or over the last number of years, in the hot seat, so to speak, making decisions about where to allocate capital and which companies to buy.
And what, I mean, knowing how finances are for the everyday man, it's stressful. I mean, managing your own money, and it's, managing your own £5 is a stressful thing. And here you sitting sort of managing and making decisions with big bucks that's not even, wholly your own. How are you not a stressed wreck sort of thing every day?
I think it's actually easier to manage other people's money, is the honest truth, even though the sums involved are larger. I think you view it through a less emotional frame of reference, let's call it, because it's not your own. It's not to say that you shouldn't have your own money invested in funds that you manage, and I do advocate for that. But I believe that there's an element of detachment. It's almost a little bit like, maybe it's the wrong parallel to draw, but I kind of imagine it would be like a doctor treating third-party patients as opposed to treating their own family members. I kind of feel like you do a worse job if it was your own family members, because you're emotionally involved. And so yes, it's a stressful job. I think it's always got stresses, now more than ever, and we'll talk a little bit more about that a little bit later. But I feel that managing third-party funds is probably, there's a level of emotional disconnectivity which I think assists, in fact.
So I mean, talking about the whole game, and from the point that you're at now, the hot seat that you currently occupy, sort of thing, it is a big money game. But is this a world that's accessible to other people? Because I mean, again, for the everyday guy, I suppose it seems a bit daunting. I feel like I should have 7 companies, and then then I can only sort of step into your guys' world.
Absolutely. So I mean, there's different ways of building an investment portfolio and different vehicles of building an investment portfolio. You've got what would be traditionally known in South African terms as a unit trust, which is really the equivalent of what I'm managing currently. And typically the minimum sums involved for unit trusts are quite low, in fact. So it could range from a 500 Rand monthly debit order to perhaps a 10,000 Rand minimum lump sum. But the point is, it's not multiple millions of rands that you need to allocate, whereas that's the one route you can go. You can go the unit trust route, where you can own units in a fund which will buy shares for many different investors into that fund.
Yeah.
Or you could set up a segregated share portfolio which has got its own nuances and tax considerations as well. But that typically, to achieve efficiency of investment with respect to the kind of brokerage rates that you're going to be paying and diversification that you would need, you've got that probably only makes sense for much larger sums of money. I'm talking certainly more than 100,000 Rand, and probably even possibly more than $1 million, I would argue.
Yeah.
Segregated portfolios worth one's while.
It's quite interesting, because I mean, obviously unit trust is something that we hear quite a lot about, and I mean the way you put it forward, being sort of the range in amount that you can play in, really is good. So I mean, in my mind, I'd say so. Unit trust would be a nice entry level way to get into things, and then where do you think the point is at which you separate the men from the boys? I mean, is it the size of the investments, or?
Yeah, I don't think it's really a debate around necessarily you've graduated from unit trusts and now you can go into something bigger. Actually, unit trusts are an excellent vehicle for any size of investor, and indeed the mandate that I'm running is seeded by one individual in particular, a very wealthy individual who's put his money into a unit trust. Now, other investors will go in there and invest alongside him, but he's happy with that vehicle because it makes sense for him.
Yeah.
Ultimately, you've got the benefits of the way in which tax is treated within unit trusts, whereas if you have a segregated share portfolio, every time you sell a share or you buy and sell a share, that's a capital gains event. Every time you sell or buy a share within a unit trust, the ultimate owner of the units doesn't actually pay tax until such time as they sell their units. So you can actually rebalance your portfolios within a unit trust to the benefit of clients, or hopefully to the benefit of clients, without them having to trigger capital gains tax events every time that happens.
Yeah.
So they actually are very, very good vehicles for any size of investor. And I would say that quite frankly, the only time really that I would say that segregated share portfolios make more sense is where you're trying to achieve a specific outcome that is different from what other investors might want. So for argument's sake, you might have a problem with investing in tobacco stocks, whereas other investors maybe are not too concerned about that.
Yeah.
But if you go into a unit trust, everyone's getting the same thing. So you might want to tailor your portfolio to specific outcomes or specific risk tolerances.
But it's more general field.
Correct.
More general.
So there's more ability to tailor an investment outcome in a segregated share portfolio, but generally speaking, outside of that, there's not many other advantages.
Yeah. No, that's an interesting one. And where are the best investment spots now? I mean, I think from growing up, our parents always said to us, property is the one way to go. You can't go wrong with property. And now we're sort of living in a world where you're hearing horror stories. And I think Carte Blanche did an episode on it. And, there's guys that are trying to offload properties in really affluent parts of Joburg. And, they're losing a couple of % on stuff. So in your opinion, do you think it's just a phase, or, should we be looking at other things?
South Africa's got its own unique set of challenges. I think that's the first point to make. One must remember that South Africa is it's less than 1% of the world's economy. So I think from the perspective of investment, you've got to consider global diversification. Now, it's very difficult to globally diversify if you're buying into one property. Now, that gets onto a very important discussion on property. There's not only one way to buy property. You don't have to go and buy an apartment or a house and get a bond over it. You can also buy companies listed on either the JSE or international exchanges, which they themselves invest into a very diversified portfolio of real estate assets. And those are called REITs, or real estate investment trusts.
Yeah.
So you can, for a very small outlay and in a compartmentalized amount, invest in a very diversified property portfolio via stock exchanges. You can buy these real estate investment trusts and own the benefit of having a professional management team look after that portfolio for you, and receive the rents and chase up tenants and do all the hard grind without you having to do it yourself.
Yeah.
I think the other thing to talk about with respect to property is that when you're investing into one property in particular, you don't have diversification as the first point. But secondly, your transaction and frictional costs of ownership and buying in and selling out are very high.
Yeah.
So if you think about the process of buying a property in South Africa,
it's astronomical.
and then subsequently selling it down the line, should you need to, you're probably looking at anywhere from, it depends on what price point you're talking about, but it could easily cost you 5 to 10% of your purchase price on the way in terms of transfer duty,
agent fees,
lawyers' fees, etc. And then when you sell, you've got to pay anything from 3 to 7% in agent's commission.
Yeah.
And so your frictional costs of owning property are extremely high. Okay.
Yeah.
And that means that you've got to have a very long holding period, and you also need property price inflation to be on your side. Now, the problem we've had in South Africa is that you've had very low GDP growth for a very long time, and now you've got the added problem of immigration of middle class and upper class income earners, which is obviously undermining the property market in key nodes in South Africa. When will that end? I don't know. Is it a trend that's here to stay? Also hard to say. But the point to make is that I think the overriding comment I'd make is that if you want diversification, you can own property by other means than just buying a direct apartment or a house. You can,
and you can in a non-traditional way.
Correct, and you can buy property assets all over the world without having to leave your living room, so to speak. You can literally buy listed property anywhere in the world. And so I would always advocate for global diversification first and foremost, and secondly, diversification by asset class and sector. But again, I'm coming from the perspective of somebody who's grown up in equity markets all my professional career, so it's what I know. And I suppose the one benefit of physical property that we haven't spoken about is a behavioral one, in the sense that when you see share prices moving every day, sometimes those price movements will scare you, like we've just had in the last month or two. Because you've had a 30% sell-off in a lot of companies, and in some cases it's been even worse with the coronavirus. And that might tempt a lot of people who don't have the resolve to sell out at a loss. Whereas if you own a physical house, you're not seeing a price on a screen every day, even though the value of your property might be changing. And probably is changing in real time.
You're not having to look at it every day.
You don't have to look at it every day, and you might be living in that house, so you got to live somewhere. So I guess that's a behavioral benefit of physical property versus listed property. But for disciplined savers who are starting with small amounts of money, I think it would always make sense to invest into listed equities, be that operating businesses or even real estate investment trusts.
So understanding that the world is connected in every sense. And the smallest of things, I mean, we watch how the stock markets behave every time Trump says something, or when Zuma used to say his things, it was just always, everything gets thrown out of tilt just from a simple human being sort of making a statement. And then you get something on a more immense scale, like, COVID-19. Maybe before we get to COVID-19 is to touch on the whole junk status thing, because I think as South Africans, we like to complain. And I think a lot of people, I do think it is somewhat a survival mechanism. Some weird survival mechanism sort of thing, like a Chandler from Friends. But we all like to mention, we're going to junk status. But I kind of feel like you've got I call it the Brexit effect, where everybody wants something, but they're not actually sure what it means for them. And I feel like that's what junk status is. So if you could elaborate, I mean, what, in a nutshell, what does that mean for the everyday man?
Okay, so ultimately, the financial system and world markets have a structure whereby there are funding needs across companies, across individuals, across countries, where countries have to borrow, companies have to borrow. And how do we establish the credit worthiness of a company or a country in a standardized manner, okay, across all markets. And that's why we've had what we call the ratings agencies have come into existence, and they've been around for a long time. But their job is ultimately to, as objectively as possible, ascribe ratings to different companies and different countries or other economic entities, which effectively is passing judgment on their ability to repay their debts on time, and without having to adjust terms, for argument's sake, like missing payments or terming out their payments. And so the ratings agencies judge all debt instruments issued around the world, both by companies and countries, and what's been happening now. So our ratings have been slipping for some time. And the reason that that's been happening is that the country, in simple terms, has not been living within its means. We've been spending more than we've been bringing in tax revenue and running very high fiscal deficits for quite some time, to the extent that South Africa's national debt as a share of GDP has gone from, let's call it 25% in the earlier part of this, let's call it 2008-9, to where it is now at 60%, excluding the debt of the state-owned entities, which probably adds another 10% to that number. So we've got the highest debt to GDP that we've had in a number of years. And now ratings agencies are saying this is not sustainable because your debt is high, first of all. But secondly, you've shown no resolve to actually rein in your spending. Or, on the other hand, implement policies which are going to grow the size of your economy and thus reduce the debt burden from a denominator point of view, where you're actually growing you're not just taking up a greater size of the pie with debt, you're actually growing the pie.
And they're actually supplying you with options to say, listen, do A, B, or C.
Absolutely. So the ratings agencies have been very clear about what needs to happen. They've been speaking about structural reform in terms of getting control of the wage bill in government, which has been out of control for years, and also introducing more growth-friendly policies like liberalizing your labor markets, making it easier for skilled resources to come into the country, privatizing of assets where there's not necessarily a strategic requirement to have them, like RSA is the perfect example. You tell me how a bankrupt airline is an economic enabler where there's got plenty of other airlines supplying travel routes in our market. So it's not like consumers don't have a choice there. So the point is that there's been a lot of guidance from the ratings agencies as to what needs to be done, and we haven't been doing those things. And it's a whole other discussion, but I think it's largely a political discussion, right? And so what's happened now is that when ratings agencies adjust your credit rating downwards, that effectively pushes the cost of your credit up. So if I have to go and borrow money as the government, it's going to cost me more money to borrow now than it did before the ratings downgrades that took place, right? And so that means that a greater proportion of my budget is now taken up with interest payments, because to refinance the same amount of debt, which ultimately has to get refinanced on a rolling basis all the time anyway, because you have rolling maturities of debt, because the interest rate has gone up, it's going to cost me more money. And so that's more money that I could have used to finance infrastructure development or skills development, feeding the country.
It seems like an exponential death, really. I mean, it's
a death spiral, and the only way you get it under control is to take some really hard decisions. And these are the decisions that the government unfortunately hasn't been taken up till now. And perhaps this is a good time to get on to COVID-19, because this could be the case that forces their hand, where they actually they've run out of options, where now you're in a crisis. You've come into this crisis in a weak position. Many other countries went into this crisis in a very strong position. So they have the ability to spend their way out of trouble. And you're seeing a lot of government expenditure to try and bail out companies and people around the world, in the US in particular. They're throwing trillions of dollars at the problem. And the trouble is we don't have that money, because we've effectively been mismanaging our income statement and balance sheet for so many years. So this will force the government's hand, I believe. And ultimately, this is the time where they have to make those tough calls. And it's not, I think it goes tougher than just not giving state employees wage increases. You've actually got to cut heads. They've got to shrink the government. They have no choice but to privatize state assets now. It's got to happen.
And it's, I mean, like you say, it's not even about people taking cuts or anything. It's actually, you have to start saying to people, sorry, we can't have you. And it's shocking to hear stats like SAA's having the most cabin crew and staff. And I mean, it's not even by one or two heads. It's a good 2-3 heads per airplane, which is absurd.
Yeah. I don't know those numbers, but I'm sure that they're pretty scary.
Yeah. Now that we're on the subject of COVID-19, I was chatting to my neighbor about it, and we're talking about, do you stash your cash in gold? I know at the beginning of this whole thing, everybody was running out to buy gold, and is it better? Are you better off keeping your cash flow sort of fluid? Should you just keep it as cash? And
I'm not a gold guy. I think what this has taught us is that having a cash float of at least a couple of months as an emergency fund is a good idea. I think that if there's one lesson to come out of this is that have some cash on hand, not just to be able to take advantage of lower share prices, for argument's sake, which we do now have, but also for the unforeseen event where you might lose your job. For the first time in our lives, there's many people, professionals and unskilled staff alike, where their jobs are on the line. We haven't seen an event like this in our lifetimes. And so I think an emergency cash float is a good idea. That's lesson number one tick. We think that's a good idea. From an investment perspective, it's always, it's a bit more nuanced, because by the time you think it's a bad idea to be invested in stocks, it's probably too late.
Yeah.
And what I mean by that you've already had a severe sell-off. We had in the space of 2 or 3 weeks, global markets fell by very close to a third, over 30%. And you haven't seen a sell-off of that speed. I won't say of that extent, because in the 2008 financial crisis, for argument's sake, markets got cut in half.
Yeah.
But that took place over a 5-month period. This has happened essentially in 3 weeks. It's unprecedented.
Yeah.
We've got to go back to the 1929 depression to see stock market moves this quick.
Yeah.
And so you've had a major adjustment, and some of that has been recouped to the extent that markets are probably down 20% now. And the way that I frame this is to say, okay, share prices are down 20% at the moment. And now this is not investment advice. Please don't, your listeners mustn't take this
disclaimer.
Disclaimer, disclaimer everything I'm saying here. But if you try and rationalize share prices down 20%, okay, it's highly likely that profits of many companies, possibly all companies on average, might fall by a lot more than that. In fact, if I was a betting man, I'd say that most companies will see their profits cut in half this year, maybe even worse.
Sure.
And you'll probably see a couple of quarters where they get losses, because we've never seen an event where the economy gets literally stopped, and it's a mandated stop, where the government has said, guys, you must close your business, you must close your doors. Everyone goes and sits at home, and apart from groceries and essential services, you all go and sit at home and you don't trade. And it's happened around the world. It's unprecedented. We've never seen anything like it. So it's clear that there's damage to the economies in the short term. And I think you're going to see a very deep recession. I don't know how long, but it'll be deep for as long as it happens.
Yeah.
We're seeing numbers thrown around of between 8 and 10% for major economies in terms of an annualized contraction this year. And so to get back to the discussion around profits and valuation, yes, profits will fall a lot this year. And it's almost not about this year anymore. It's about saying, when thinking about the price of assets like shares, what really matters now is how quickly the recovery takes place, what the shape of the recovery is, the extent of the recovery, and how protracted it becomes. Because ultimately, the value of a business, if you were buying a business, forget about what shares traded at in the market. If you were buying a private company, and you're going to buy the whole company, you'd be less concerned about how much money they make this year You'd be far more concerned about the sustainability of long-term profits.
Yeah.
What's the next 10, 15 years going to look like? Do you think this business will generate cash flows for the next 15 years? Okay, that's the key question you've got to ask yourself. And so the reason that stock markets have fallen by 20%, where we have an event on our hands which is going to cause a much deeper earnings recession than 20%, is that there's this notion that businesses are more a function of cash flows in the outer years than just 1 year's worth of profit.
Yeah.
And so the big debate that investment professionals around the world are having right now, myself included, is what does the shape of the recovery look like? We know that 2020 is a wipeout now. There's no debate about it.
Yeah.
All we need to work out now in our heads, or try and assess the balance of probabilities of, is what the shape of the recovery looks like and how long it takes us to get back to the pre-COVID trajectory.
Yeah.
And it could be a few years.
That's an interesting one. I mean, mentioning before that we do the gin trade, and craft gin, especially in South Africa, has been treated to the biggest boom over the last few years, which has been great. And now it's come to a grinding halt. And, you know, you're seeing a lot of the guys suffering, because I think also in the early days, you're trying to make your money do more for you. So the little bit of extra fat you've got, you chuck it into marketing and whatever. I think, you know, not everybody is thinking, let's start a rainy day fund with gin sales climbing and escalating. And I mean, even the lay of the land looks good for another 2-3 years if we look at countries that are ahead of the curve, or ahead of our curve, should I say. So, you know, you look at it, all the information you're given, and it looks great. And, you know, we shouldn't panic at all. And then, this comes in, it sort of, smashes you, and people are going, well, we're not too sure what to do. And then basically the whole mindset now is to think, what is the world after COVID-19?
I think people sometimes and you've seen a lot of commentators, or a few commentators, saying the world will never be the same again. The life as we know it is over. And I personally don't believe that. I think that the changes that we see will be nuanced, and there will be some permanent changes. There's no doubt about it. If you think back to the post 9/11 world, where you know the attacks on the World Trade Center in America. So what changed permanently after that? Airport security changed permanently. You then had aircraft cockpit doors that were reinforced with deadbolts that you couldn't break into. Nobody was allowed into a cockpit, and that is a permanent change. Okay. Did that stop us traveling? No. So there was an initial shock of people not wanting to get onto airplanes as a result of the World Trade Center attacks, and it probably lasted a few weeks. But ultimately, we recovered those losses and then some over the years, and people got back to the old habits of traveling. And I suspect that this will be a similar case, where we're going through a world trauma right now. There's no doubt about it. What we're living through right now is perhaps the most traumatic event of our lives. And it will leave some scars, and it will leave some permanent changes, but will human nature change intrinsically? I don't believe so. And I think people will always want to travel. People will always want to socialize. And that means that, for want of a better word, getting together with each other. So are we all going to live via video conference going forward? No, I don't think so. Might we spend 1 day a week working from home as opposed to 5 days a week in the office? That's possible. So you might see less demand for office space, but is travel dead and buried forever? I don't believe so. But are we going to have temperature scanners at airports and perhaps questionnaires about fevers? Quite possibly. And that could be a permanent change that we see, but it's nuanced changes. It's things that don't necessarily preclude us from living our lives. It's things that we just have to adapt to. And that's the way in which I think it's going to change. And I think from the perspective of how companies should be thinking about this right now, I believe it's a case of saying economies have been stopped right now. You're in survival mode. So you switch off non-discretionary expenditure. You make sure you've got as much cash buffer as measured in months of liquidity. So how many months can I survive without having any turnover, without having to go bankrupt? That's the calculation that many businesses need to make, and try and maximize that time period that they can live without turnover until we get back to normal, where countries open up again, we're able to move around, we're able to do the things that we used to do.
Yeah.
So it's about surviving. It's not about how much money you make this year. It's about being able to get through this and come out the other side with your business intact and with your personal balance sheet intact.
Yeah.
Because this too shall pass.
I like that. I like that statement of saying, you know, it's not about how much money can I make it out of the year. It is very much the statement of if your personal books are right and that your business is still able to open its doors at the start of 2021.
That's
so.
What...
Yeah, I think it's the last one, and it's just a question that I thought of as you brought it up, is obviously the SAA, and they've unfortunately their little fingers have been denied entry into our wallet. What do you make of that? Do you think? I mean, this SAA thing has been going on.
I think it's the best
so
news
long.
I've heard all year.
Yeah.
And there's a saying: never waste a good crisis.
Yeah.
And this crisis has forced the hands of government to cut off the lines of funding to a money pit that had no end.
Yeah.
There was no end to how much money we would have thrown at SAA, and now we don't have that money to waste on frivolous political vanity projects. Quite frankly, that's what SAA is. It's not a mission critical asset. You could argue that Eskom is mission critical. We need to fix it.
Yeah.
Because we need electricity, and yes, there's other ways to get around that. You can deregulate the electricity market and have independent producers coming into supply, but that's going to take time. Whereas SAA, quite frankly, we don't need it.
Yeah, like you said, there were other options. It's not as if we only had one provider.
I think there are some technical, let's say, technicalities associated with the disorderly bankruptcy of SAA, and that mostly relates to their technical division, which I understand does a lot of maintenance work for other aircraft, other airlines landing in South Africa. So one needs to try and manage that process carefully to the extent that you don't disrupt the ability of other airlines to fly into the country because there's no maintenance facilities available. So that's an important aspect of the whole debate. But quite frankly, as far as airplane seats is concerned, we don't need SAA as a carrier.
Yeah. No, it's an interesting one, and like I said, it's been going on for yonks and yonks. I thought we'd be talking about the same SAA story for the longest time, and now it's interesting, and it's exciting to see what the guys will do without this pain in the side moving forward.
Yeah.
But yeah, man, I appreciate you making some time for me today and having a little chat. Yeah, all in all, I learned a few things.
Good. Great.
Sure.
Great chatting. Thanks.
Stay safe. Enjoy the rest of lockdown. I suppose it's only officially restarting season 2 now of the lockdown. So
exactly.
Enjoy that, man.
Netflix show. Season 2,
I'm sort of running out of Netflix at this point now too. But anyways.
Thanks, Temba. Have a good day. Cheers.
You too. Bye.